Good evening, everyone. Larry Pershing here, CFP. Oh, nope, pointed down right here. Founder of Optimum Retirement Planning, firm that focuses on helping people close to and in retirement. Um, Tonight we've got a fun thing to talk about here. We've talked about capital gains and Roth conversions, and I've got a little case study analysis to go over with you all on how to create tax efficient income in retirement. And really, this topic is so important because if you don't understand how capital gains affect the taxation of your retirement income, and how Roth conversions interact with capital gains and specifically capital gains income and your other income sources, it's going to be really hard to not get creamed by taxes or avoid mistakes that create a lot of taxation in retirement. So without further ado, let's jump into it. Hey, David, thanks so much for joining. Oh man, and he's commenting on YouTube. Love it. Thanks so much for joining, David, as always. All right, jumping into it. Oh, but of course, don't forget about a quick disclaimer here. All this information is educational in nature, guys. None of the information is specific legal, tax, or investment advice. Before taking any action for your situation, always go talk with your tax, legal, or investment professional. All right, let's jump into it. So, you might have seen this before, and if not, you will see it when you retire. And there's all these people saying, "Hey, there's a way to pay no taxes in retirement. There's a magical place." And that's partially true. There is a 0% tax bracket. It's only for long-term capital gains income. I'm going to go through like what long-term capital gains income is, like a whole deep dive, capital gains, all that good stuff. But just for right now, just know that this is going to be like growth in a stock or investment. It's going to be in a non-retirement account. You have to hold it for over a year to qualify for long-term capital gains treatment. And then when you sell that investment, basically just you give it to your tax preparer and automatically happens. As long as you hit the qualifications, you're going to end up in this special magical place where there's a 0% income tax bracket for federal income tax purposes. State, not talking about states today. States are their own mess. Like, for example, California, you get hit with that normal income tax rate. Same with Illinois on long-term capital gains taxation for the most part. So, but yeah. So there's this 0% tax bracket, and it's great, right? I mean, paying 0% federal income taxes is sweet because most of us, our whole lives, we've been paying a lot of income taxes, and to get 0% feels like okay, like I deserve this, which we all do. So how exactly? Well, actually, yeah. So let's see these tax brackets. So here it is. This is like the proof. Proof is in the pudding here. It's going to depend primarily how large the bracket is on if you're single or married or what your tax return filing status is. But we can see for an unmarried single individual, $0 of income up to $44,000, roughly $600 of income. If you're as long as you're below $44,600 of income, all your long-term capital gains income taxed at 0% for federal income taxes, and married couple have double that for long-term capital gains income that is taxed at 0%. Again, only long-term capital gains income. If you have income from a treasury bond that matured or just normal interest income, because darn it, interest rates are high now, then that's still going to get taxed at ordinary income tax rates. And we're going to talk about like how that fits in with all this in a second here. Now, and again, these are the single or these are the normal ordinary tax rates. And again, they start at 10%. You're $0, you start at 10% there. So, I mean, 0% is way better than 10%. And long-term capital gains income is always taxed at a lower rate than ordinary income too throughout the brackets. You can see here, long-term capital gains income only goes up to 20%. If you have income of over $492,000 as a single individual, then that starts to get taxed only at 20%. So you have close to $500,000 of income and you're still only touching the 20% tax bracket. Now, this isn't quite true because there's something called the net investment income tax that kicks on for single individuals at over $200,000 of adjusted gross income, which is different. This bracket is for taxable income. We're not going to get into that technical difference today, but that's another 3.8%. So for a lot of the 15% bracket and all of the 20% bracket, you can really just add on 3.8%, basically 4% taxation there for long-term capital gains income. But again, let's say 20% for long-term capital gains. You got to have income close to $500,000. Let's see how long it takes for a single individual with normal, ordinary income to hit that. Let's say that it blows through the 10%. 10% bracket goes up to $11,000. 12% goes up to 44. At 22%, so you're already overpaying more than the long-term capital gains tax bracket. You're at $95,000. And 24% up to $182,000, 32%, 231. Oops. So on and so forth. So you can see that 35%, once you get over $500,000 of income, single for ordinary income, you're paying 35% taxes on income over $500,000 versus long-term capital gains 20%. So that's a 15% difference, and even still, even still, long-term capital gains at 0% basically in these two brackets, and then the 22 bracket for ordinary income. Well, if you have long-term capital gains income, it's 15%. So any way you slice it, you benefit from shoveling income into long-term capital gains. Now, it's difficult to get income in long-term capital gains because a lot of people, especially people close to in retirement, you've been saving up in your retirement accounts, usually pre-tax, maybe Roth. Now, Roth is 0% taxation too, right? So that's also great. Another way to pay zero taxes in retirement. But anyone who tells you to convert like every dime you have into a Roth IRA to never pay taxes again is probably giving you bad advice. I'm going to say in like 95% of scenarios. You almost always don't want to convert everything in your pre-tax retirement account to Roth conversions, but money in your pre-tax retirement account, so your normal traditional IRA, rollover IRA, 401k, all that pre-tax money, when it comes out, it's get taxed at ordinary income tax rates, not the long-term, not the better, lower long-term capital gain tax rates. So, in addition to the 0% tax bracket I just talked to you about with long-term capital gains, it gets even better, folks, even better because of the way the tax code works. There's something called the standard deduction. And what that is the government basically says, hey, we're going to give everyone, or I shouldn't say everyone, most people who file a tax return, a certain amount of income just tax-free. We're just going to say, hey, your first, for 2023, it's $13,850. So for most people, your first $13,850, we're giving you tax-free, and that's ordinary income or long-term capital gains income. So really, if you think about it, the standard deduction and married filers, married filing jointly get double the standard deduction. As a single individual, is $13,850 is for single. So married filing jointly is going to get double that. It's $27,000 whatever it is and change. So for a single individual, you get close to $14,000 tax free from the government, and then on top of that, then you have another $44,000 roughly if you have only long-term capital gains income of tax-free income. So now you're up to, let's see, what's 44,625 plus 13,850. That's $58,475 of potential tax-free income in retirement just to start. So your first, however much is tax-free, which is fantastic. Now there's a catch with this though. When you start doing Roth conversions with long-term capital gains income, things can get messy because Roth conversions can essentially push the long-term capital gains income out of the 0% tax bracket and into the 15% tax bracket. And it kind of just does this automatically. Like you do a Roth conversion if you had a long-term capital gains income beforehand, before you did the Roth conversion, or really even if you recognize it after the Roth conversion, anytime during the year, calendar year, you may have a little oopsie and cause some income that wasn't going to be taxed because it was in the 0% tax bracket, get it pushed into the 15% tax bracket. And this is the number one mistake I see retirees making with their Roth conversions. Actually, like number one most common mistake I see is they aren't thinking about how it affects their capital gains. may want to do a Roth conversion, and all of a sudden when you start running the math, you go, shoot, this is bad. I'm getting creamed here. And so I want to show you an example because I think that's a really simple example, because I think that's going to really make this a lot more clear about what I'm talking about here. Okay, married couple, 63, retired, no Social Security income, but they do have a pension of $22,000 and they have $60,000 of long-term capital gains income. Oops. Oh man, this is gotta be careful with that. It's real finicky, real sensitive. So, okay, so we're gonna forget about the standard deduction for a second. I know I mentioned that, I threw that in there, but like, let's keep these things simple. Forget about the standard deduction. So their first $22,000, remember, married couple, is that pension is ordinary income. Okay, you can think of it as like, well, yeah, same thing. Pension income, almost same thing as like pulling money out of a pre-tax retirement account. So your first $22,000, that's going to fill up the ordinary income tax bracket. So what happens is that long-term capital gains income gets stacked on top of your ordinary income always. So remember, there's two different types of income here you have to know about. There's ordinary income, which is really most other types of income. So well, wage income is technically not ordinary income, but it's taxed at the ordinary income tax brackets. Wage income just also has FICA taxes on it, so it gets taxed again, which is not fun potentially if you're under, well, always has the Medicare taxes on it. So anyway, so in retirement we don't have wage income anymore. We're not worried about that. But so your interest income, income from money market funds, treasury bonds maturing, treasury bond interest, what else? I bond interest, really any sort of like income you can think of from investments that doesn't qualify for long-term capital gains tax treatment is going to probably be put in the ordinary income brackets here. And so this pension income definitely going to qualify for ordinary income. So $22,000, that fills up the 10% bracket, but then long-term capital gains is going to stack on top of that. So that's where we can see, hey, they also had $60,000 of long-term capital gains. So it goes on top of the pension income. And because they're married, it still qualifies for the 0% tax bracket. So right now they have $82,000 of income and they only have to pay a 10% tax on $22,000 of that, which is only $2,200 in taxes on $82,000 of income, which is an average tax rate of, drum roll please, about 3%, 2.5%, 2.68%. That's like nothing. I think we'd all love to only be taxed at around 3% for $80,000 of income. So this is the good news, is that in retirement, your income taxation can really go down a lot. It's really common to see that. And now this is where Roth conversions play this role, especially early in retirement. You see lower income taxation if you have these sources of income where you can get long-term capital gains income from these sources. So non-retirement accounts, taxable joint accounts, individual accounts, taxable brokerage accounts, certain trust accounts. These are all kind of the sources where you get long-term capital gains income from. Okay. Now, what happens if this example right here, we're going to add a $60,000 Roth conversion to it. So everything else being equal, we're just adding $60,000 Roth conversion to it. What's this going to do? How is this going to affect our taxation? Remember, long-term capital gains, they get bumped. So any ordinary income goes first, then long-term capital gains income. So think about what you think is going to happen. And what happens? Well, Roth conversions are also a source of ordinary income. And so what happens is that Roth conversions, they basically get to cut the line, right? Long-term capital gains, like, hey, I'm here. And Roth conversions like, sorry, I know the bouncer, I'm cutting you in line. And so what they do is they bump the long-term capital gains up the tax rectangle here, And so because of that, now long-term capital gains income all of a sudden gets hit into the 15% tax bracket. So we can see the pension, stays the same, right? But then the Roth conversion stacks on top of the pension, and then that causes the capital gains to be pushed up. And now there's still a little bit of room in the 0% tax bracket for capital gains. So about $7,200 doesn't get taxed, but then the remaining 52,000, we'll call it $53,000, gets hit with the 15% long-term capital gains tax rate. And again, I mean, this is still better than if that long-term capital gains was taxed as ordinary income, because now it would be taxed at the 22% ordinary income tax rate. So the long-term capital gains, while it's getting bumped out of 0% to 15%, which is a big jump, right? 15% tax increases, it hurts. It's still better than recognizing ordinary income at 22%. So long-term capital gains tax brackets are are always lower than ordinary income tax brackets. Maybe, I mean, okay, I say always, maybe there's some like really niche scenarios I'm not thinking about, but for the most part, that's the way it works. But still, it kind of stinks, because what happens is, what this does to the Roth conversion is, you think you're doing a Roth conversion in the 12% tax bracket. You say, hey, yeah, Roth conversion at 12%. I want to lock in 12%. That's super low. I think that's a really good deal for me. But then you realize, oh, shoot, I just lost all this capital gains income I caused it to lose the privilege of being taxed at 0% for federal income tax rates. And instead, it got bumped up to 15%. So if you do some rough math and you say, hey, this Roth conversion taxed at 12%, plus it caused my capital gains income to be taxed at 15%. Well, 12% plus 15% is a 27% marginal tax rate for the Roth conversion. In this example, it's going to be a little bit lower than 27%, because some of the capital gains, it was a $60,000 Roth conversion, and not all $60,000 of capital gains got taxed at 15%. Some of it stayed at 0%. So it'll be a little lower than 27%, but it's probably going to be around 25% or something. So still, you think you're in the 12% tax bracket, but because of the complexity of the tax code and what I like to call stealth taxes, you really need to dive in and understand it deeply. It causes an increase in income taxation. So you think you're in the 12%, but really you're paying tax rates at 27% on your Roth conversion, because that Roth conversion is kind of causing double taxation. The Roth conversion is getting taxed, and that's causing capital gains to get taxed at an increased rate. Okay, not to belabor the point, but I think examples are super healthy and helpful here. So let's see what would happen if we change up the numbers just a little bit here. So we have $22,000 of pension income plus around $67,000 of long-term capital gains income. So again, pension, right? Tax at 22%, fills up the 10% bracket. And then basically we have enough capital gains where it fills up the full long-term capital gains tax bracket of 0%. That full thing's being filled up. Now, let's say we add Roth conversions of $67,000. I know in the title here I have 60,000, but I screwed that up. That's supposed to say $67,000. So we can see, hey, again, pension tax at 22%. Now the Roth conversion, because it's ordinary income, it gets to cut the line. And so it's going to fill up, it's going to go first in taxation, and it's going to be taxed at 12%. And then the long-term capital gains income is going to be taxed last. And now it's out of the 0% tax bracket because there's more total taxable income. And the Roth and the long-term capital gains income is going to be taxed at the 15% tax bracket. I do want to, okay, yeah. One thing I think I forgot to note that I think is really important here that I just said, I really want to reiterate, is these income figures. This $44,600 is all taxable income. So it's not just your long-term capital gains income here, but it's saying as long as you have total income. Oh, well, yeah. So what it's saying is, hey, as long as your total taxable income is below $44,600, then any amount of that is long-term capital gains income, it's going to be taxed at 0%. But now if you have, let's say $60,000 of income and $30,000 of it is ordinary income, well, that's going to fill up the first, $30,000 of this bracket. And then the remaining $30,000 of long-term capital gains income about $15,000 that will get taxed at 0%. Then the other 15 is going to be pushed in the 15% bracket. So again, because of the way the tax code works, you just got to be really aware of this. And so we can see again how Roth conversion income accounts as ordinary income, and it can push your existing long-term capital gains income up into higher tax brackets. Now, you may say, well, like, man, I can't believe the IRS does this to us, but this is actually beneficial for you. This is better than, or most of the time, this is better. It's going to reduce your taxes by having ordinary income be taxed first rather than long-term capital gains tax first. Because if you flip this around and you had your long-term capital gains tax first, it would be taxed at 0%, but then your Roth conversion income would be taxed at 22%, roughly. The brackets don't line up cleanly, so there's going to be a little bit breakage here, but mostly the Roth conversion is going to be taxed at 22%, and then your capital gains income taxed at 0%. So the IRS actually, it's not like mean or out to get people. This can be beneficial for a lot of people. The way they do this can still reduce your overall taxation. But yeah, that's the way it works. And kind of just some people say, well, are you sure? Like, is that really how it works? And should I really be thinking of my Roth conversion tax at 27% versus 12%? And the answer is definitely yes. So we have, just kind of breaking down the taxes here from this last example. The pension taxation doesn't change, right? Because the pension income always is in the 10% bracket, $2,200, 10% on $22,000, $2,200 in taxation. We have capital gains income of $67,000 roughly before the Roth conversion, not taxed at all. After the Roth conversion, about $10,000. We're going to owe about $10,000 in taxes because the whole $67,000 is taxed at 15%. And again, before the Roth conversion isn't taxed at all because there is no Roth conversion income. But after Roth conversion, that full $67,000 is going to be taxed at 12%, which is $8,000. So we can see before Roth conversion, total taxation, $2,200. After Roth conversion, total taxes due $20,300. Now, of course, we added more income, so we would expect to be taxed more, but you can see there's a huge jump to it. If we just kind of look at the difference between the two scenarios, the difference is the Roth conversion amount of $67,000. And so the additional taxes caused by the Roth conversion of $67,000 is our capital gains taxation of $10,000 plus the Roth conversion taxation of $8,000, $18,150. So how do we calculate the marginal tax rate for the Roth conversion amount of $67,250? Well, we take the total taxes that Roth conversion would cause, total additional taxes caused, $18,157 divided by our Roth conversion amount, and we get 27%, which is also 12% plus 15%. So that's all the math I got for you today. But I just want to get you thinking about this, where if you're thinking about Roth conversions, we're coming towards the end of the year now. It's almost Roth conversion season, my favorite time of the year. And, so be careful with this. Know if you have long-term capital gains income. And how do you tell if you have long-term capital gains income? Well, the two main sources of long-term capital gains income I see for retirees is because you sold an investment that had appreciated in value. And we're going to go more into this in a second, but you sold an investment that appreciated in value. And so you just kind of have to think, well, did I make any stock sales? And this is in non-retirement accounts, remember, not in retirement accounts. Did I make any sales of investments that had grown in value? Okay, great. And usually your custodian, Vanguard, Schwab, Fidelity, whatever, will tell you, oh, this is long-term capital gains income. This is going to be short-term. They usually have some live tracker on their website for you. Usually it's in cost basis and realized gains. You want to look for realized gains or cost basis. And then the cost basis tab will have a sub tab of unrealized and realized gains, generally where you can find it. And it'll be tracking it for you through the year. And the second thing that gets a lot of retirees is mutual funds, not ETFs for the most part, but mutual funds have forced capital gain distributions where the mutual fund essentially just distributes capital gains. You don't have a choice. If you're an investor in it, you just get it on a pro rata basis based on how much money you have invested in the mutual fund. And you can't really control it. It's controlled by the investment managers of the mutual fund. And they just basically say, hey, the mutual fund made some sales in the fund. And because of that, everybody has to split the capital gain income on it. And so they'll also distribute some money that was due to the sales in the fund as well for the capital gain distribution. But so then you got to pay it. And what kind of stinks about that is that if you just bought in the mutual fund, you might not have even gotten the gains. Like the mutual fund might have been selling highly appreciated securities over the past 10 years. And even though you've only been in the fund for a month, all of a sudden you're stuck with the tax bill. Like, what the heck? But and I know like that sounds crazy, but well, it is crazy, but it's true. It's the way it works. So there's the two main sources of long-term capital gains for retirees. I see I've got some questions here. So let's see what we got. Really good question here. For planning, do you include all Social Security as ordinary income along with pension? So I'm just going to go back to the example I just showed you guys. And Social Security has its own special tax rules. So I don't know if Social Security is technically ordinary income, but the way it works is that it goes in the ordinary income bucket, and Social Security income can bump your long-term capital gains. But yes, I'm pretty sure Social Security is taxed as ordinary income, because the way it kind of works is, I mean, technically 0%. None of your Social Security can be taxed, or if you have enough other income sources, then an increasing percentage of your Social Security will be included as taxable income, and then it's going to be taxed at the ordinary income tax rates. So yeah, you can basically think of Social Security as like, hey, it's going to go in this ordinary income bucket with the pension and Roth conversions if you have it. And again, Roth conversions also, and this is actually, I wasn't going to do this because I thought, this may blow some people's minds, but if you have Social Security income and you have this long-term capital gains income and you do a Roth conversion, then the Roth conversion can cause the Roth conversion income is going to be taxed. And then on top of it, because you've increased your income, the more of your Social Security benefits are going to be taxed. So now the Roth conversion gets taxed itself and causes Social Security to be taxed. And because you've increased your income, your ordinary income, you then bump the capital gains up into the 15% tax bracket. And so you cause a triple taxation scenario. I've heard it called like the tax torpedo. You can still get tax rates as high as, what is it? Like 30, I think it's only 30, maybe it's even like 40%. But because of the way the tax cut, it used to be a much bigger deal pre the 2017 tax cuts. Now it can happen, but it's in a smaller band of income it can happen for. But yes, it can happen. So great question. Social Security, ordinary income, Social Security can bump up your long-term capital gains. Thank you for asking that wonderful question. David Foltz, he's always got a good one. Is a goal of Roth conversions to keep RMDs from pushing someone, into dividends becoming taxable? Okay, wait, I got to reread that one. Is a goal of Roth conversions to keep RMDs from pushing someone into dividends, maybe someone's dividends becoming taxable? So David's asking a good question. I'd say it's a little bit more on the advanced end, but so what he's kind of asking is, one of the benefits of Roth conversions is, remember, you're getting money out of your pre-tax retirement accounts into a Roth IRA. Roth IRA, as long as you follow the withdrawal rules, you get tax-free investment growth. You can pull the money out tax-free. So it's all tax-free in there. But then an additional benefit of that is that by getting the money out of your pre-tax retirement account, once you hit RMD age, RMDs are required minimum distributions. The government, is patient but not generous. The government is going to force you to take money out of your pre-tax IRA, 401k accounts, etc., and pay the taxes on it. Roth IRAs do not have RMDs. You're never forced because the government base says, heck, I don't, I don't really get any money if you take money out of your Roth IRA. So I don't really care. We don't have RMDs for Roth IRAs for now, at least. So where I think David's going with this is that, hey, one, if you're really thinking ahead with Roth conversions, you can do some Roth conversions early on, and then what that will do is lower your income in the future, right? Because you're taking money out of your pre-tax accounts, and your required minimum distribution is based on how large your IRA account is, your pre-tax retirement account. So if you do Roth conversions, you're de facto lowering the amount of money in your pre-tax retirement account, and you're lowering the principal, and you're getting future growth out of it. So it's kind of like a double whammy to help reduce RMDs in the future. And if you do that, then in the future, when those RMDs come out, maybe that won't cause this capital gains taxation bump. And yes, it's a valid strategy, and especially because if you're concerned about your dividends or long-term capital gains income getting bumped by RMDs, when you get into your 70s, it means you probably have pretty sizable taxable accounts, money in non-retirement accounts. And if you have pretty sizable money in non-retirement accounts, a great way to turbocharge the benefits of Roth conversions is to use that non-tax money to pay the taxes on Roth conversions. It's almost like a way to make retirement contributions in retirement. It's pretty cool. Now, you do want to be careful that if you're selling highly appreciated securities, you do want to be careful about that, because sometimes the payback period can be pretty long. But especially if you have like cash or even like, some bonds sitting around, it can be a great way to boost the benefits of your Roth conversion, save more taxes over time, funnel more money into the tax-free part of your portfolio, and basically just be more tax efficient in retirement, produce more income by paying less taxes over time. Sorry, David. So to answer your question, because I'm really going like around in circles here, it's a valid strategy, because it means you have all that money and you can kind of boost the benefits of Roth conversions by using some of it, which also then will help reduce it's kind of a double whammy for reducing that problem, because you'll be reducing your RMDs and reducing the amount of money you have in your non-tax retirement accounts that will produce dividend income for you in the future. So it can be good, but I always hesitate with a lot of this, like especially when I'm working with clients, because remember, like, I'm not Nostradamus. Well, okay, Nostradamus, bad example. He was terrible at predicting the future, but I can't see the future. So I'm making, projections out 10, 15 years for someone. It's different if maybe in a couple years, maybe they're like 68, 69, haven't started Social Security yet. RMDs are coming up in 5 years. That's a lot different. But even still, 5 years is a long time. But like we're talking 10, 15, 20 years, we're thinking about Roth conversions to do this, to avoid this potential capital gains taxation bump. We don't know what the tax code is going to be 20 years from now. And again, we're projecting a lot of investment growth between now and then. That may or may not happen. So there's a lot of things. So I do hesitate a little bit thinking through those sorts of things and just saying, hey, the future is uncertain. I want to be really careful that the Roth conversion probably makes sense, even if in the future RMDs aren't causing dividend income to being bumped in this, higher in the long-term capital gains tax brackets. I'd still want to maybe make sure, like, hey, even if that doesn't happen, what tax rate are we avoiding in the future with the Roth conversion? Does it make sense on that more conservative baseline versus going for the more aggressive approach of doing Roth conversions to avoid a potential future capital gains, bump up for a decade or something, 10, 15 years from now? Whew. That was a mouthful. But David always asks really thoughtful, insightful questions. Love it. So thank you for that. Man, the questions keep on coming in. So folks are selling their investments with the long-term capital gains in order to pay the taxes associated with Roth conversions. Yeah, absolutely. And it can be, again, it depends on how highly appreciated the investment is. So, on the one end, we have, you bought a stock, 2 years ago, and the stock is up 1%. So like 99% of the amount of money locked in that stock, you can get out tax-free, right? Because you only have 1% gain. So if the stock is worth $101, you bought it for $100, that's a $1 income gain. But then you use that $101 to pay the taxes on a Roth conversion. That means you can get $101 more into the Roth IRA, which essentially, if you think about it, you lose $101 in your taxable account. And I guess you have $1 taxation. So maybe you even withhold $1. So just $100 from that, the net after tax amount of the selling of the investment in your non-retirement account, you can then get $100 more into your Roth IRA. So you've really just moved that money around, and you only gave up $1. Now you have $100 that's guaranteed to be tax-free. I shouldn't say guaranteed, but as guaranteed, there's a really, really, really good chance it's going to be tax-free in the future, especially if you follow the withdrawal rules for Roth IRAs. So it makes a ton of sense because the investment appreciates, 10% in the future. Then if you had to pay 15% tax on that 10% in the future, 10% on $100 is $110. 15% on the $10 growth would be $1.50. So you paid $1 to get $100 in there, and then you have 10% growth on that $100. It's $110. If you had left it in the non-taxable account, you would again hit with the 15%. Now you got in the Roth IRA, it's tax-free. So it really can boost the benefits of Roth conversions. And then you also just have more control over your taxable income. So this is a way, so that's the main benefit of paying taxes for Roth conversions with non-retirement account money, even with long-term capital gains treatment is, you get the tax hit up front, but then you're essentially funneling that money into tax-free Roth IRA, getting tax-free growth in the future, which is great. And two, the other benefit to it is that, any amount of any asset with long-term capital gains in it usually is not 100% long-term capital gains. There's some cost basis in here. We're going to go into that in a second, like how to calculate all that. I'm going to talk about it. But because of that, it also just means you can do more Roth conversions because you don't have to recognize that much long-term capital gain. If you have $100 and even a basis of 50%, it means you had you bought an investment for $50, it doubles in value. Now have $100 investment value, you sell it, you get $100. You only have to pay taxes on the $50 in growth at long-term capital gain. So even at 15%, 15% of $50 is, what is that? 750, 43. So you're getting $43.50 net from the growth plus the $50 in basis, $93.50 net. And you only recognize $50 in income. And so then you have that $93.50 net cash to pay the taxes on a Roth conversion. So basically you can just do more Roth conversions with less money versus paying the taxes out of the IRA, because an IRA, if you pay the taxes for a Roth conversion from the IRA, let's assume you're over 59 and a half, don't have to worry about the 10% early withdrawal penalty. Then, you do a $10,000 Roth conversion. Well, you have to pay, let's say, 12% tax on the Roth conversion. So you have to pay 12% on $10,000. Well, that's $1,200 of tax you need to pay for. So, but you can't just say, okay, well, yeah. So you would say, okay, I'm going to only put $8,800 into my Roth conversion, into my Roth, and then withhold the $1,200. So, you lost out on $1,200 in your Roth IRA versus if you had $1,200 in long-term capital gains. Even at, your investment's doubled, so you're at 50% gains. Your basis is going to be $600, and then you pay $600 in growth. It's at 15. Well, if the Roth conversion's at 12, let's even say the Roth conversion's at 12, and this is at 15%. Then you pay the 15% on the $600. That's going to be, I don't know, like, we'll say $100. I'm not going to do the mental math here. So that means you paid $100 on it. You have $1,100 net. And so you can get $9,900 in the Roth IRA, out of the $10,000 Roth IRA. And then, you can just do a $9,900 IRA, or you'd have to do the little calculation to figure out that little difference. But so it can be helpful. Now you do have to be careful though, if you're doing this Roth conversion amount, and that if you pay, if you sell some investments to pay for the long-term capital gains tax treatment, how it's going to be taxed. And like that is another factor in this decision is if you think that you can get all of your long-term capital gains income out at 0%, but then you're doing a Roth conversion, you're thinking, well, okay, if I do the Roth conversion, do I pay the taxes with my long-term capital gains income investments? But I'm gonna have to sell them at a 15% tax rate. But normally you don't think in your life you're ever gonna have to pay 15%. You're only going to be in that 0% tax bracket. Well, then that's another situation where maybe it doesn't make sense. But I think for most people, what I see is, hey, we may be in the 0% tax bracket now, but we're probably going to be in the 15% tax bracket in the future, just because with RMDs, Social Security, you know, we're probably going to be at least in the 15% tax bracket in the future. So paying 15% now isn't really a huge major tax increase in our situation. But if someone thought they were only going to be in the 0% long-term capital gains tax bracket their whole life, then yeah, paying capital gains at 15% versus 0 is not great. That might not be the best situation for using a long-term capital gains asset to pay the taxes on a Roth conversion. That's probably way more than you wanted to know. I know I like hammered on with that, but there's a lot to it. But yeah, again, it all comes down to how much long-term capital gains you're going to have to long-term capital gains income you're going to have to realize when you sell the investment to pay the taxes for Roth conversion. You know, what percentage of the value of the investment it is. And I wish I had like a good rule of thumb for you, but it's situation specific. All right. Let's see. Why do financial experts always look at the marginal rate? I just don't get it. It's what I really pay when all is said and done at the end of the year is the effective rate, which is usually significantly less than marginal rates calculated. Love this question. And it's really, really tied in to what we're talking about here. And this actually, your exact question you asked is the exact reason I put this slide up in the presentation. So one, the effective tax rate. So for those of you who may not be as familiar with the terminology, the effective tax rate is also known as the average tax rate. So when your taxes are all said and done, how much income taxes did you pay? Do you divide that by your total income recognized? So for the year. So for example, if you had $10,000 of taxes you paid and you had $100,000 of income, well, then your effective tax rate is 10%. Okay. And so what they're saying is like, well, you know, experts are always talking about the marginal rate. So what the heck is the marginal rate? The marginal rate is essentially, hey, for any additional amount of income I recognize, what is the additional tax burden that income causes? So if you had you did $100 Roth conversion and that $100 Roth conversion caused you to pay additional taxes of $10, that would be a 10% marginal tax rate because $10 divided by 100, 10%. All the effective rate is the marginal rate on every single dollar of your income. If you calculate the marginal rate on every single dollar of income and you add it up, you get the effective rate. So the effective rate is nice. It's a nice summary of your taxation, but in retirement, when you have so much control over your income sources, you know, it pays to look at the marginal rate because you can start to see, well, okay, my effective rate might be 10%, but you know, really, maybe that effective rate is a bunch of income that's taxed at 0% and then some income that's taxed at 30%. And maybe if you had reworked your situation differently, you could have avoided having income tax at 30% and only had that income tax at 10%, and then your effective rate would have been 5%. You know, I'm just making up the numbers, but that's the idea. That's why experts harp on it constantly about the marginal rate, is because that's really what matters. That's, you know, you add up your marginal rates, you get your effective rate, and that's the tax rate you're paying. So in this Roth conversion example, you know, the effective rate, we could calculate this before the Roth conversion. This example has $89,250 of income. So $2,200 of total taxation on $89,250 of income is 2.5% roughly. With the Roth conversion scenario, we have, well, 67,250 times 2 plus 22,000. We have $156,000, $156,500 of income. So $20,357 of taxes divided by $156,500 of income is a 13% effective rate, which doesn't sound so bad, but you realize, hey, I was really paying 27% tax on $67,500 of this income. That kind of hurts. That really drove up that effective tax rate from 2.5, 3% to 13%. So that's why we talk about it all the time. That's why we harp about it. I hope that is helpful and was a decent explanation of it. But so essentially, if you pay attention to marginal, I think bottom line, if you pay attention to marginal tax rates, you can reduce your effective tax rate and just pay less taxes overall. Because sometimes you can change the income sources or, for example, not do a Roth conversion so that you keep your marginal taxation rate low, which then means that you'll keep your effective tax rate low. Okay, so no other questions. This is just, again, tax brackets we talked about before, and understand why capital gains are important. Yeah, so it can help you save taxes if you understand capital gains. You don't want to sell and invest a big, highly appreciated investment. If you're 5 days before holding the investment for over a year, you're probably going to want to wait and pay less taxes on the gain. So it's important. All capital gains is the sales price of something so all capital gain is the selling price. You sell something you bought, and it's the sales price minus the price you bought it for is the basic example. Now, really, there's something called cost basis, which is like a concept with the IRS, and it's the price you paid for an investment plus or minus all sorts of additional things that can happen to the investment, like fees or commissions you had to pay to buy the investment. So like for a home, you buy a home for $200,000, but then you also paid, let's see. Well, I mean, most of the time, I think in some areas you have to pay the realtor fees when you buy. So then you had to pay realtor fees of $20,000 too. So you would say your total cost basis is $200,000 plus the realtor fees of $20,000. Man, if you had 10% realtor fees, that would really suck. I hope that doesn't happen anywhere. But that's the basic gist of it. And so you have a capital gain when you sell something for more than you bought it for, essentially. And a capital loss is when you sell it for less than you bought it for. And you can only get capital gains on capital assets. And so capital assets are really they're always going to be something that you own personally. So not through your business. Not through anything else, but something you own personally, or it can be like a trust. Certain types of trust can get it passed through for capital gains tax treatment. But so homes, cars, stocks, bonds, technically like furniture, but again, like a lot of those household things, like, they depreciate in value, so you never have to worry about it, but you don't get to take a capital loss, or it doesn't help your taxes if some of the personal things you buy lose value. It's only when they gain value that you have to sell them. So like, technically for some people, for example, you bought a car, maybe bought a used car in 2019. And then in late 2020, 2021, you got to sell your used car for like a 10% gain. Boom, capital asset. You got to pay capital gains tax on the sale. Technically, well, whether that got reported or not, different story. That'd be something to talk to your CPA about. So, you can see a lot of IRS publications about more information if you want to get in the nitty gritty about it. But how capital gains are taxed depends on 3 factors, or at least 3 primary factors. There's always little edge cases in the tax code: how long you hold the asset, what the asset is, what account your asset is held in. So if you hold a capital asset, something like I'm just going to use stocks from now on, because I think that's like the capital asset, the investment that most people think of when it comes to long-term capital gains. That's the most common one I see substantially for most people. I think homes are like a second one, but homes have their own exemption for capital gains tax. We'll talk about that. So for stocks, you hold a stock for over a year. It got to be over a year. Then it can qualify for long-term capital gains tax treatment. If you hold a stock for a year or less, 365 days or less, then it's going to be treated as short-term capital gains, which is taxed as all other sources of ordinary income, pensions, IRA, pre-tax IRA distributions. And so short-term capital gains don't really give you a tax advantage. Long-term capital gains, as we've talked about, big tax advantage. Let's see. Yeah, so I think this is all just stuff that I already said. Capital gains tax brackets, again, they're low. Ordinary income tax rates higher. So also too, capital gains taxation depends on the asset you're holding. So for example, stocks, you hold them for over a year, they qualify for the long-term capital gains taxation treatment. You can get these 0, 15, 20% rates. Same with a primary residence, but then there's something called collectibles. So this could be gold, jewelry, like coins, like artwork. They basically are subject to a maximum rate of 28%. So they have different rates. These long-term capital gains rates that we've been talking about, like the 0% tax bracket, only certain capital assets like stocks or potentially a bond. Which is really cool. If you buy like a longer term bond now and interest rates drop in the next year or two, you could have a long-term capital gain on the bond. And so you could sell the bond instead of having to recognize the bond as, or the, ordinary income. It gets complicated, the bond taxation, but you can get a long-term capital gain from the bond and essentially convert some of the bond income from ordinary income to long-term capital gains income. But of course, that all depends on future interest rates, which are really hard to predict. Yeah. And then lastly, we have unrecaptured section 1250 gain, subject to a maximum 25% rate. And this is really only for business related property. The biggest one I see is rental property. That's where that can really bite you in the butt. And that's especially if you have rental property and you have depreciation. And essentially the tax code basically says, hey, we're going to give you this depreciation expense you can use to reduce your income. But guess what? Keep notes on that, keep track of it, because we may essentially recapture all that depreciation you used. That's going to reduce your cost basis. And then we're going to take the difference there and subject it to gains. And so you want to make sure that your depreciation expenses are reducing income at rates higher or at least equal to what the unrecaptured gain you would be subject to when you sell the property in the future. It also depends on what account you have the asset in. So stocks, right? We've been talking about 0% tax rate, but as long as it's not held in a retirement account, you can hold the same stock in a pre-tax retirement account. Well, guess what? No more long-term capital gains tax treatment, even if you've held it for over a year, because all money that comes out of a pre-tax retirement account gets taxed as ordinary income. End of story. And then you hold the same stock in a Roth IRA. Well, guess what? Now you don't have to pay any, you don't have to worry about short-term, long-term capital gains, how long you hold it. It's just you had that stock in there and all the growth comes out tax-free as long as you follow the withdrawal rules. And then, of course, you have taxable accounts, where we just talked about all these rules. I got another question here. Let me see. David, are there certain marginal tax rates we should be more aware of? The really hard thing about marginal tax rates is that they incorporate the published, tax rates you see on the tax brackets that you can look up. And then there's you have to add state taxation to it, which again, we've just been talking about federal this whole time, but states open up a whole nother can of worms. And then all the other stealth taxes, like one example just being the long-term capital gains bump here. And so it's really hard to say because marginal rates just vary widely. Like if you look at you try to create like a marginal rate of each income, it's just so individual specific. It's really hard. Some that just come to mind is that there are some marginal tax rates that are over 100%, which is crazy, but it's true. So, for example, IRMA, who some of you may know about, which is Medicare premiums part B and D. The premium amounts are based on income limits. So if you go $1 over these income limits, your Medicare premiums increase hundreds to thousands of dollars a year for that year. They kind of they're on a rolling basis, so they reset each year based on your income. But so if you go $1 over that income limit, let's just say your Medicare premiums increase by $500 for the next year. Well, that's like a 5,000, 50,000% tax increase, like something crazy. You want to be aware of that. And then ACA premiums, that's like another marginal taxation case that can be really high, especially because it varies throughout. And so sometimes the ACA like marginal phase out can be like 20% by itself plus 10 or 12% tax bracket you're in. And you can run into situations where ACA plans, if your income goes up to a certain limit, you lose some of the benefits. There's like what is it, like Silver Premium or Silver Plus? There's some, what is it like? I forget the name, but for some ACA plans, if your income's low enough, you'll get like, essentially they will reduce some of the out-of-pocket costs. And so if you have those out-of-pocket costs, then oops, your income goes up a bit, then you can lose them. And it can be a pretty high marginal phase out, like marginal tax rates of over 100%. Same with the ACA have some like certain, like they won't claw back all your premium tax credits if your income goes over a certain amount. Again, this is at really low income levels, though, generally under like $40,000 for people. So those are kind of two that come to mind, but there's so much stuff in the tax code here that's kind of the whole thing, where there's so many marginal rates to be careful of. You just kind of got to know what you're doing when you're creating retirement income to be aware of. Just know these marginal tax rates exist, and there's a lot of them. That was a couple examples that came to mind. Okay. Like income tax rates, could the long-term capital gains rates increase and or thresholds reduce or eliminated for the feds to pay the deficit? Yeah, absolutely. And I think it's I don't know. I think okay, so absolutely it is a possibility. My speculative opinion, which again, one financial advisor here talking, I definitely don't know the future. I think it's going to be hard for them to get rid of the 0% tax bracket because it's on income of like $40,000. So I think most people it would raise revenue, but it's going to tick off a lot of people. So politicians won't do it. But I think it's much more likely is actually higher income earners. They might phase it out where they basically say, hey, if you earn enough money, like for example, let's just say anybody who has over $1 million of income, any capital gains income above your $1 million, we're just going to tax as ordinary income. I think that's like a really easy pickings in the tax code. Like I think the famous example is Warren Buffett says, hey, I pay less taxes than my secretary. That's not right, because Warren Buffett, will recognize hundreds of millions of dollars some years, or millions at least. I don't know about hundreds, but he's pretty tax efficient. Warren's good about tax deferral and whatnot. But his secretary has higher taxation rates than him. He says that's not fair, and that's exactly because of these long-term capital gains tax rates. So I think that would be a really easy thing for them to do. But if you don't anticipate having several $100,000 a year in retirement, I think you should be feeling pretty good. But absolutely, that's just my opinion. I could be completely wrong, and who knows what the situation's going to be like 10 years. But I think that's like the easy, like, hey, we can, raise revenue, increase taxes on couple, tens of thousands of people in America and produce a bunch of revenue. Like that's going to be an easy sell versus like reducing the brackets or increasing the whole thing. Because it's pretty popular and Yeah. Let's see. Okay. Oh, I got another follow-up comment. Okay, I'll go back to that, but let me finish up the presentation real quick. How to calculate capital gains taxation and taxable accounts. So to determine the basis of your assets sold, and that's the basis is basically what you paid for it. There's some adjustments to it. Oh yeah, so I have an example here. You purchase a vacation home for $100,000, spend $50,000 fixing it up. You sell the home for $200,000, so you have a capital gain of $50,000 because your basis is 150, 100 purchase price plus $50,000 for improvements. So always track for your primary residence too. Improvements you make, there is a capital gains exclusion on your primary residence. Yeah, and I think I won't go into this because we're kind of running low on time. We're already an hour over. I don't know if anybody really wants to get in the nitty gritty of how capital gains like net out with each other. Short term gains and losses net out first, long term gains and losses, and then you net out the net of them. So that's that. Yeah. So I think that's all kind of boring stuff. I don't know if anybody cares about that. So primary homes, up to 250,000. So for whoops. So for your primary home, geez, this is finicky. You live in your home if you follow the rules. You may be able to exclude up to $250,000 of capital gains for single taxpayers, $500,000 for married taxpayers from your taxable income. So you buy a home for $500,000, you sell it for $1 million. You're a married couple. You follow some rules, you might be able to get the home tax free. You don't have to pay any income on it. That can be pretty nice, and certainly something to consider when buying and selling homes. And again, and then two, maybe, or let's say in the same example, you bought it for $500,000. Let's say, you bought in like Los Angeles or something, you can sell it for $2 million. Well, you have $500,000 exclusion. You still have $1 million of gains, but maybe you spent $500,000 fixing up that home. That's why it's so important to track your receipts of repairs and improvements, maintenance you make to your home, so that you might be able to reduce your capital gains one time. And I should say, step up in capital gains too. For a lot of these assets that would have capital gains, if you sell them, if you keep them your whole life and you die, then generally on the date of your death, the basis gets stepped up to the value of the asset on the date of your death. So, for example, you have a stock, you bought it for $100,000, you've had it for 30 years, now it's worth $1 million. You pass away, then it's worth $1 million on the day you die. Then the basis gets set up to $1 million for your beneficiaries. So when your beneficiaries inherit it, they sell it right away for $1 million. They don't have to pay any capital gains. The capital gains go poof, disappear. So that's another like planning strategy as well, for people, especially if you have a lot of money in taxable accounts. You don't think you're going to spend it all in your lifetime. If you have businesses, that you can get exemptions from capital gains or preferential treatment. Gifting is a little more complex. If you gift an asset that has capital gains in it, then the basis usually carries over. But if it's at a loss, it's a little funky. I did get the step up in the fourth one. So yeah, that's basically it. I think I'll get to this follow-up question now. I appreciate the dialogue here. So let's see. I didn't follow your marginal versus effective rate explanation. Let's say I had a $100,000 Roth conversion that was calculated at marginal rate of 25%, and say maybe $100,000 in W-2 wages with taxes withheld. If I paid that $25,000 marginal tax rate via estimated taxes for the year, I would have overpaid my taxes. So I don't really pay the marginal rate. I pay the effective no matter how you calculate things. So your effective rate is a combination of your marginal rate on your $100,000 in wage income and your $100,000 of Roth conversion. So yes, like for your purposes, um, how do I want to get my point across? Oh, okay. Well, so yeah, this is the issue then. With your example, so you did $100,000 Roth conversion, marginal rate of 25%, and you had $100,000 in W-2 wages with taxes withheld only on the income tax of your W-2 wages. Well, maybe your wages were only taxed at, let's say, 15% effective rate. So you withhold 15% effective rate for your wages. So you'd have $85,000, but then you had this $100,000 Roth conversion. So now you need to withhold an additional $25,000 for the Roth conversions. That's a total of $40,000 of taxes. So you don't pay the effective rate. I mean, the effective rate is it's like it's kind of like saying, hey, half dozen of one, or half dozen of two things, or a dozen of things. It's we're talking about the same thing. The effective rate is just the sum of marginal taxation, but you don't actually pay effective rates. Like it's not like, hey, your Roth conversion, you pay it at an effective rate of 10%. Like, no, you don't. That's not how the tax code works. That's just the average tax rate you paid across all of your income. And the only way to know that is to calculate um, all of your income sources. And again, marginal rate, I guess I see your point where, hey, if you have all of your income, does marginal at the end of the year, does marginal rate really matter? Where marginal rate really matters is when you're making decisions. Because then it's okay. My effective rate is let's say in this example, let's say you have $100,000 in W-2 wages with taxes withheld. Let's say your taxes have an effective rate of 15%. And now you're considering on whether to do a $100,000 Roth conversion. So now you need to decide if a 25% marginal rate in your Roth conversion is appropriate or not. But what we do know is that if you don't do the Roth conversion, your effective rate is 15%. We know you had $100,000 in wages. We know you're going to have to pay $15,000 of taxes. So that's an effective rate of 15%. We know that. But if you do that $100,000 of Roth conversions, you have to make that decision, and the marginal rate helps you make that decision because it's okay. If I do the $100,000 of Roth conversion, that additional $100,000 is getting taxed at 25%. So what that's going to do is increase your effective rate as well. And then, I mean, there's a whole lot that goes into, is it worth it to pay 25% or not? That's like a whole separate discussion. But at least marginal rate is telling you what you're actually paying on that $100,000. You're not paying, let's say, if it's $100,000 Roth conversion, 25%, that's $25,000 in taxes, plus let's assume a 15% effective rate on the $100,000 of wages. So that's another $15,000. So $25,000 plus 15 is $40,000 of taxes total on $200,000 of income, which is 20% effective rate. But we know that you actually paid 25% on that last $100,000 of Roth conversion. So your effective rate is always going to be lower than what your marginal rate is, unless all of your income is taxed the same, but all of your income isn't taxed the same. For the majority of people, they're going to have income taxed at different rates because of how the tax code works. So I don't know if I'm really saying it any different to help make it clear. But let me see. Let me read it one more time, or feel free to shoot me a comment back if it's making more sense or not. But let's see. Oh, I see what you're saying. If I paid that $25,000 marginal tax rate via estimated taxes for the year, I would have overpaid my taxes. Um, well, actually, no, you would have underpaid your taxes. So that's the other thing here is that your marginal rate in Roth conversion is 25% on just the $100,000. So if you withheld $25,000 from your wages for your Roth conversion and your wages, you would be way underpaying because your wages are you haven't accounted for the taxation of your wages as well. So your wages are going to be taxed at some rate. I don't, we can assume whatever rate it's going to be for this example. But if you only withhold $25,000 from your wages, you're going to owe a bunch of money come tax time because you have $200,000 in income. So again, marginal rates, really think about it as, hey, can I recognize, when you have a decision on if you want to recognize more income or not, is really where margin rate comes in because it's letting you know uh, what rate it's going to be taxed at. And if you're okay with that, now, of course, that rate will then filter into the effective rate. But essentially, the margin rate's usually always higher than the effective rate. So it's going to cause your effective rate to go up. No, I'm saying I pay an additional 25K in estimated taxes. So, okay, so let's say you had $100,000 in W-2 wages and you withhold $15,000 because that's what you estimate the taxes will be on your W-2 wages. Then you do a $100,000 Roth conversion and you withhold an additional $25,000 from your W-2 wages. Then you won't have overpaid. You'll have paid exactly correctly. Now, if you withhold 25% from your W-2 wages and your Roth conversion, then yes, exactly, you will have overpaid. But that's because the way the tax code works, it's a progressive system, so tax rates go up over time. So your $100,000 in W-2 wages will be taxed less than the Roth conversion is. But that's the whole point of marginal tax rates, is figuring out, oh shoot, like as my income goes up, I'm paying higher and higher tax rates. Do I want to do this? And that's another conversation of, is it worth it to pay the higher tax rates or not? Or you can get funky situations in the tax code where tax rates go down. And then it's like, oh, I can lower my effective tax rate by adding income. Like, yeah, let's do that. But that's like really few and far between. So ponder it. Hope it's helpful. For all of you who have stayed on, man, we're at an hour 15. Really appreciate you guys. Happy retiring, go create that tax efficient income. And, if you need any help with that, I'm here. I do that stuff for people. You can go to my website, optimumretirementplanning.com, schedule a meeting with me for free to strategize about it. But, otherwise, I will be off the next 2 weeks. I will have some content for you guys, though. I got my YouTube channel spun up, and I'm getting the content ahead of time so I can, release it while I'm gone. I'd really appreciate if you guys, checked out my YouTube channel, subscribed, or you can even go to my Facebook reel. I posted one on my 2-minute retirement Facebook page. Follow that would be great as well. And let me know what content you want to see from me, retirement planning wise, or not just on Roth conversions, but anything retirement planning related. I'm an open book. So signing off. I'll see you all next week. Or no, not next week. Not next week. 3 weeks from now. Because next two I'm off. Yeah. So 3 weeks from now, man, that'll take us into October. It'll be serious. Yeah, that'll take us into October. Yeah, October 3rd. So serious Roth conversion season. Get ready. It's that time of the year. Bye guys.